Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Morning, everybody. Thanks for tuning in this morning. And like the man said, feel free to call. You know, people are telling me all the time, I forget to give out the phone number. So I'm going to start today's show by giving out the phone number. 216-901-0945, 216-901-0945. Feel free to give us a call on anything financial that you'd like to talk about. And it could be stock market, can be how do you not run out of money during retirement. It could be things on health insurance. And in fact, I've been doing a lot of work on basically the whole financial planning program. I reapplied for the program. I took the courses a long time ago. I'm almost embarrassed to say how long it's been. And things have changed quite a bit. So I just decided, I'm going to do it. I'm going to go ahead and take the courses, retake the courses, and sit for the exam again, and keep it up to date. Unbelievable how many things have changed throughout the last even 5 years. 5 years, there's been an enormous amount of change. So keeping up with that's kind of a major job. But having said all that, retirement planning, financial planning is it's actually pretty simple. And when I say that, I mean mathematically. The math is easy. Okay? The math is easy. How much should you save? Well, it depends on what kind of lifestyle you want. And that's the hard part. What kind of lifestyle do you want? That's the hard part. Figuring out what kind of lifestyle you want to have. What do I mean by that? Well, the vast majority of people could get by on about 80% of what they make right now. So if you're getting by on what you're making right now, some people aren't, by the way. When I say the vast majority, there's a large portion of people that don't fall into that. So we're going to have to talk about that in a few minutes. But right now I see somebody called in. And again, if you'd like to join in today's conversation, 216-901-0945 and go right to, I guess, is it Bill?
Hello?
Hello?
Yes, hi.
How are you?
Good, how are you?
Pretty good. Is your name Bill too?
I'm sorry?
Is your name Bill?
Yes, my name is William. Bill, also.
Okay,
yes.
All right.
Yeah. I have a question about MLPs.
Mm-hmm.
Are you familiar with Dominion Midstream? Have you ever heard of that?
I'm pretty sure I've owned it at one point in time because it was part of an index, and
they had a FERC ruling that changed, I guess, the tax law on it, and went from 32 down to 13, and the FERC ruling was just changed again. It's starting its way back up. I was wondering if you knew anything about that ruling.
I can look it up for you. That's not something that I have seen personally, but the last few weeks for me have been a nightmare. I've been so busy. And I'm normally not this busy. This is normally my slow time of year, and I'm like, I can catch up on all my reading and all this. But no, the FERC ruling, that would be a big plus for those MLPs. So I put together an index. Mine's equally weighted. And it concentrates just on the midstream, those in the transportation. And it's got a really nice yield. The yield on it's like almost 6%. But it's the yield 6% because the share prices are down quite a bit from their peaks. At one point in time, that whole industry, that whole sector was down a little over 50%. And it's actually been clawing its way back up slowly. And it really didn't make sense, by the way. It doesn't matter whether it makes sense or not, because stocks in the short run will do a lot of things they shouldn't do. And MLPs they act just like stocks, but they do have some tax breaks. The paperwork with them is a nightmare. I can tell you that for sure.
Is it?
Yeah.
Yeah.
But you can some firms will let you put these in your IRA, some won't. like Fidelity doesn't want you to put those inside of an IRA because they're not sure how the IRS is going to rule some of the income. And they were talking about, they haven't brought this back up yet, but the custodians, so the Fidelities of the world and the Schwabs and the Ameritrades would literally be required to collect some of the money in taxes on the distributions for those products that are in the IRAs and their accounts, not the customer. So they're going to make the custodians collect it. And Fidelity said, yeah, nah, we're not going to go down that path. So you're just not allowed to put them in. And, but I use a different custodian that I hold. I got every midstream company that's in the index, I hold on an equally weighted basis. Boy, that's really been holding my portfolio back.
Oh, I know. Yeah.
But I at some point
it went down when whatever you invested went down over 50%. So that's
actually it was up. So I'm not really down. I'm not down on it much at all. Like a couple percentage points, but because I was in before it actually dropped like that. So the very first year it was a really good year. It was up about 20% or so. But from that peak, from where it peaked, it went down a little over 50%. And then,
right.
So if you reinvested all your dividends, now what you're doing?
I'm sorry?
So if you reinvested all your dividends, you're just breaking even.
Oh, okay. All right. Well, thank you kindly. I appreciate your time.
Hey, thanks for calling.
Okay.
And if you have a phone call, question, or comment, sometimes I feel like, I feel bad. People call in and it's kind of like drinking from a fire hydrant. You just wanted a sip of water. So, but I'll try. That's all you can do, right? Anyway, the MLPs, talk about a thorn in my side. To just be breaking even over the past few years is not pleasant when you've seen a lot of other indexes go up. I still have confidence in them. I don't know how long it will take to show a decent return. I'm not sure how long it takes to actually, I think if they were, if you look at it, if long-term interest rates are 3% and you're getting close to 6% and it's in a dividend that's tax-free, what is wrong with that picture? So, but yeah, that's investing. Doesn't make sense in the short run sometimes. And the short run can be several years. That's what's really challenging about investing. You can be absolutely right, and it can take the market several years to catch on. And that's the, I forget what they call it. Oh, yeah, the value trap. So all your value investors, they buy stocks because they're good deals, good bargains, and then they stay good bargains, or they become better bargains by dropping even further, typically right after I buy them. And you have to wait. And if they're not paying dividends, that can be incredibly frustrating, because at least if they're paying a dividend, you can reinvest the dividend and buy more shares when the share price is down. And you can, by the way, you can have that set up to do that on your brokerage accounts today. I don't know any firm that doesn't offer that service. So, which also gives me some solace knowing that my income, the income that I'm generating from that, is going in and buying more shares at lower prices with higher yields. So that really tends to work very well. That's one of the reasons that the income or dividend-oriented models tend to do well over time. And you can get into big trouble when you invest in a dividend-paying stock portfolio if you're spending the dividend all the time. You should be reinvesting that. If you want to take income from it, just try to figure out what the current yield is and then subtract that. Don't reinvest. Don't have the dividends all sent to you. That would be a problem. That could create big problems. So the big problems are you're not getting the lower prices on the stocks that have higher yields because you're spending the dividend instead of reinvesting. So if you looked at it and said, look, I started with it, it had a 4% dividend yield or a 5% dividend, whatever it is, and just send me 4 or 5%. Let's set that aside. Let's reinvest all the dividends, but then set that aside. Okay. So what's going to happen is you're going to have to claim the dividend income. That's okay. But you're going to be selling shares and buying shares at the same time. So in some cases, you actually qualify for long-term capital gains because some of the shares that you may cash in, you probably held for more than a year, which lowers a little bit the taxable burden on that. So it's a fascinating thing when you start putting dividends in the mix, especially if they're qualified dividends, which qualify for lower tax treatment anyway. Yeah, there are tons of things that we could talk about. We could actually spend the next year talking about just about those types of subjects. Doesn't really help all that much. I'm giving you the 60,000-foot view where you're looking down and saying, okay, what would be the smartest way to do this? And my opinion is you set it up, you reinvest the dividends. If you were going to take income out of it, you just determine what kind of income you're going to take, and then you take that. And at the end of the year, you're going to have to report the dividends that you got, any capital gains that you might have taken on any shares that you might have sold. Typically, you can, if you do that correctly, you can make sure that they're all long-term capital gain, which is kind of cool because then you get lower taxes on it. Yeah, but you haven't missed the opportunities to reinvest dividends in share prices when they're lower and the dividend yield is higher. If you take that out of that dividend portfolio, you're going to reduce the performance pretty significantly. And I know it's a little easier and cleaner if you just have all the dividends sent to you, but you're costing yourself money. So that's kind of a big deal. And people that like things just really, really clean. And by the way, today, with the way that your custodians download the tax information, they send you a file. You can actually take that file, and we do this all the time for our clients. We'll put it on a thumb drive and hand it to them, and they can take that right to their tax preparer. They can plug that in, take that file, and import it right into their tax software, so you don't have to worry about re-entering all that stuff into your tax return. I will tell you this, that there are still some tax preparers that do every single bit of that by hand. I'm amazed that they do that. Yeah, because the chances of that not having a mistake somewhere in there are incredibly incredibly low. The chances of them not having a mistake is incredibly low. I shouldn't make sentences like that because that is really complicated. Well, listen, if you have a call, question, or comment, 216-901-0945, 216-901-0945. And by the way, you can reach us in the office, 330-664-0700, 330-664-0700. And my goal, by the way, the whole goal for sitting in retaking these CFP courses is to go through, and I'm going to highlight all the areas that are unnecessarily complicated. I'm going to start bringing them in with me for my radio program, and probably the CFP board's not going to be real happy about this. But all the things that they try to make seem super important that are not important at all, and a lot of the things that they try to make you calculate, they try to make you come up with a number for things that you cannot come up with a number. It's a waste of your time and effort and energy. And that's one of the things I didn't like about the program. I haven't liked about it ever, is you're confusing people with unnecessary detail. You guys think you work for Congress? Just kidding. Yeah, just kidding. So, but anyway, and I started talking a little bit about this a few minutes ago. Essentially, how do you do a retirement plan? Well, it's pretty simple. It is really simple. So you've got two categories to provide income for your retirement. You have actually three. Okay, so my mistake, there are three. You've got your savings. How much money have you put aside? How much do you have in investments? Savings and investments, those are the same category. Okay. Now, according to the CFP, those are two distinct categories. Never mind. Those are the same category. Your savings and investments you put in one category. You've got income from Social Security or pensions. That's another category. That's guaranteed income. So if you have a guaranteed income and savings and investments, now that is 90%, roughly 90% of the population. Those are the two things. Pretty easy to figure out how much you can afford to live on for 90% of the population. Not a trick. So 10% of the population that owns a business or has investment property somewhere, or some other type of income-producing business or activity, whether they could still be working. That's the third category. It's income that's not coming from a pension or Social Security or guaranteed income, or from your savings and investments. So 3 categories. That's it. I can tell you, if you're young and you want to know, well, hey, I'm doing pretty good. Maybe I'm in my mid-40s. I make $80,000 a year. My wife makes the same. So between the two of us, we're at $160,000. How much do I need to be able to continue to live this lifestyle? And I didn't bring my calculator in here, so I'm going to try to make this easier on myself. So I make $75,000 a piece. Your household income is $150,000. $150,000. Now, what did I say? You're probably going to need about 85% of that. 85% of 150,000, or at least 80%. So 80% of 150,000. Yeah, that's basically 75,000. I don't know. That's 50% of it. So $120,000 would be 80% of that. Great. Now, if you want to fund $120,000 all from your savings, all from your investments, and we're not going to count Social Security or any other type of income you might get. So you're going to have to multiply that number by 20. So 80% of 150,000, 120. 120 is 5% of what? Well, basically 5% is the same thing as multiplying by 20. Get your calculator out. So you're going to need $2.4 million. $2.4 million. And then you don't have to worry about Social Security. You can donate it to a charity. And by the way, I actually probably won't want to do that. But it's a big number. It's a huge number. To replace your income with savings and investments only is an enormous task. We'll talk about how the Social Security might affect that, or pensions might affect that, when we come back from these commercial messages. Listen to Bill Bullington right here on 1420 The Answer. Stay tuned.
It's too late, too far. It's too small, it's too hard. Throwing water on that spark. Living deep inside your heart with ocean.
And we're back. Hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. You can also pick this up as a podcast at 955thefish.com, or you can go to my website, download it later. It'll be up probably this afternoon, I think, or tomorrow at the latest. And that website is bullingtoncapital.com, and you can click on the radio shows there and there again. And I hate my voice, by the way. I listen to my shows and I listen to how I speak, and I'm going, wow, that is painful. But we're here for a purpose. It's not to make me happy. It's to try to help people in their personal financial lives. And we were just talking a little bit about World's Simplest Retirement Plan. I didn't tell you that this was the World's Simplest Retirement Plan, but it is. So we'll be talking about that at all future workshops, because it's really, you know what, it's just not that complicated. And I wanted to... the financial services industry has done a great job of convincing everybody that it's really complicated. It's not complicated. It's hard, but it's not complicated. And I liken it to hitting a golf ball straight. To hit a golf ball straight and really far, first of all, you have to swing really hard. Okay. Now, when you're swinging really hard, if you don't hit the club head, if the club head doesn't meet the ball flat, it's not going straight. So it's easy to say, just hold it straight. The ball will go really far. Yeah, well, give that a shot sometime. With investing, it's a little different. You've got pressure from markets, pressure from people you hear talking, pressure from your own internal pressure, the pressure you put on yourself. And it's really hard to keep that club head straight when you've got all that pressure. And what do I mean by keeping your club head straight? Well, I mean saving what you're supposed to save, taking a look at the difference between your wants and needs. That's not easy stuff. It's really not. The investing part of it, if you do the math and you learn mathematically how to do it, can be relatively simple. Just like hitting a golf ball straight. It's simple. Just make sure the club head is flat. Yeah. Try to practice it. And trying to practice in investing, keeping your club head flat, you've got to go back and remind yourself why you're doing what you're doing. What is it like? Go through those scenarios. And when you're trying to figure out how much you need, that's where you begin. Okay, how much do you need? I've been on the same retirement plan since I learned how to do this stuff. I was actually in my early 30s, by the way, because they didn't teach us in college, which is really kind of embarrassing to say. You're an econ major, got 24 semester credit hours in finance, and nobody talked anything about this. You wonder where they were? But it's relatively easy. So take your income, multiply by 80% of your income. Now, let me tell you why 80 should suffice. Because you're not going to be paying Social Security, the FICA, and in retirement. You've already paid into it your entire career, your entire lifetime. Well, working lifetime. So you're not going to be paying that again. That's 7.5% right off the bat. That gets you down to 93. Now, I'm going to assume that you're saving somewhere between 10 and 15%. And if you're not, you should be. Okay. If you are, you're right around 80 to 83% or so. Woohoo, you're done. So when you go into retirement, if you've done that for your entire, now you can't do that when you're 60 or 61 and expect to be able to accumulate enough assets to retire. You have to start this really early. But I'm just assuming that, never mind with those assumptions. I'm just going to go back to the beginning. So take 80% of your current income. Most people can get by on that. A lot of people can get by on a lot less. Not that you want to, but they could. And that's a great thing. But you should try to imagine you're going to have to replace at least 80% of your income. Now, this is where it gets really important. Go find out what your Social Security benefits are. Find out what your pension benefits are. If you're a school teacher, if you're a public employee, they have to give you a report. I'm pretty sure they do it by email now. But they got to let you know where you stand, how much money you can expect to make at what ages. Okay, so when you get that, now you've got that number, and you can subtract that from the amount of income you need to generate from your investments, which reduces the amount that you have to save pretty dramatically. Okay, so let's say the average Social Security payment is just $1,000 a month. Just $1,000 a month. Now, that's below average. I can tell that right now. But if it were $1,000 a month, okay, $12,000 a year, $12,000 is basically 5% of $240,000. So if you're going to if you're going to spend 5% a year from your investments, and I know a lot of people have heard the 4% rule or the 3% rule. Well, I'm assuming 5% because I'm assuming that you're not going to live forever. Okay, we'll come back to that later. But let's just say I'm going to take out 5% a year. I'm going to start to deplete my principal over time, over long time periods. But that should get me at least 30 years. At least 30 years. And by the way, there's a pretty good chance if you do a lot of the things that we're doing and you don't panic, there's a pretty good chance that 30 years from now, the assets you started with are actually higher than they were when you started, even after you took out all that money. Okay? So there's a good chance that that could happen. It's not a guarantee. We're not allowed to do that. So go back to the original premise there. 80% of your current income. So let's say your current income is $70,000 because that's the average household income, by the way. Household means, household, probably 2 wage earners. That's across the country right now, $70,000. So $70,000 probably going to be collecting, you know what? I'm sorry. So sorry. I didn't finish that thought on Social Security if you're getting $1,000 a month. So let me back up a little bit. $1,000 a month, is basically $12,000 a year. $12,000 is 5% of $240,000. Guess what? That $1,000 measly payment from Social Security is saving you from having to save an extra $250,000. Wow. That's pretty good. It's saving you from having to save another $250,000. Think about that for a second. And that's just $1,000. So if you're getting $2,000, that's saving you from having to save $500,000. Think about that. $500,000. Well, close to $500,000. And so next time you start hearing about Social Security, that's why a lot of people are really upset that they keep saying, well, Social Security is going to run out of money. Well, maybe in 15, 20, 30 years if they don't do anything about it. Yeah. And you know what? By the time I get to the Social Security age, it's going to be 72. You're going to have to be 72 to be full retirement age, and I'm 55. And you know what? By extending that out another 2 years, because it's going to be 4 or 5 years from wherever it is right now. I think mine is 67. Full retirement age is right around 67. It'll be easily be 70. I think it'll be 72. And I don't really care. I'm not really counting on that anyway. But, if you are really counting on it, it can make a big difference. I wanted to retire at full retirement. Incidentally, did you know that when you're in retirement and you're not full retirement age and you're working, for every $3 you make, they take $2 back from Social Security. Now, they can't take it all. You will get something. But because you're still working and you're still contributing to Social Security, that Social Security payment still goes up. Still goes up every year. So when you hear about all the losses you're going to take by taking Social Security early and working, you better do all the math, not just some of the math. And again, that's another scare technique. I'm not sure why anybody would do that. I really don't know what their purpose is there. I guess I haven't thought about it long enough. Yeah, but anyway, so if you're still working and you're giving back a lot of the Social Security because you're still working in Social Security, so what? You're actually contributing to the Social Security payment, so your payment's going to go up as well. And it probably it depends on the situation, but I could imagine a situation where somebody worked a lot, took the Social Security, gave almost all of it back, and if not all of it, but their income was still as high as it was going to be had they just stopped working. Actually, more so because they have so much income that they were still putting money away. So I know this is probably one of the most confusing radio programs that's ever been broadcast. Because that's how my mind works. It goes into a lot of different directions at the same time. Anyway, to pull my mind back to what we were originally talking about. So let's say you got a household, $70,000 combined income. 80% of $75,000 is $56,000. $70,000, you can bet that household Social Security income is going to be a little over $2,000, but I'll round it down to $2,000. So household Social Security income through $2,000, that's $24,000. So we're actually going to have to come up with $32,000. Okay, the difference between $56,000, which is 80% of the $70,000, and the Social Security going to get is $24,000. So if we take the $24,000 from the $56,000, we get $32,000. $32,000 times 20. Remember, that's the shortcut there. Is $740,000. That's how much it would take. $740,000 in today's dollars to get that couple to 80% of their pre-retirement income. It's a lot of money. That's a lot of money. But if you got to that point, you can do it. And you can get to that point. I know a lot of people that have gotten to that point. Not that it's easy. It's not easy. But this is something I think realistically. In fact, I'm going to have to get a hold of this guy. He teaches these classes, and they're not teaching this. They need to be teaching this to 12-year-olds. The amount of, if you get them when they're 12, right before their hormones kick in, you can still talk to them. Once those hormones kick in, you can't talk to them until they're in their 30s. Sometimes more frequently, but I'm just kidding. So you need to get to the 12-year-olds, because to accumulate enough money to not to have to work is an enormous task. It's enormous. You need to start. It's easily doable if you start out young and you just follow the rules. I can show you exactly how to do that. In fact, we'll talk about that at the next seminar. Next seminar, I've got some handouts that I'm going to give away to do exactly what I'm talking about right here on the radio. And we're going to make this a key portion of this program going forward. It's just education. What do you need? How much money do you need to be able to retire? How much do you need to be able to walk away? Maybe I'm still going to have a part-time job in retirement because you know what? Maybe I just wasn't lucky. Maybe I had some bad luck. Wasn't able to put away as much as I needed to put away. That's okay. That's okay. There's nothing wrong with that. In fact, I'm going to work until I die. I'm going to be like Warren Buffett. That's the one record I think I can hope to break of his. I'm going to work until the day I die. Looks like he's going to try and do that too, by the way. And he's 87, so that's I got a long road, or a long road to hoe, if you know what that means. Anybody that's ever worked in a garden, you know, long row to hoe, you know exactly what that means. You're hoeing the garden was taking the weeds out with a hoe. You know, those tools that really kind of sharp metal object on the end of a big stick. So you know what that means. And anyway, running out of ideas as far as this goes. This is what I was talking about. The retirement planning is so much simpler than anybody ever makes it out to be. It's not easy. Simple and easy are not the same things. The same, go back to the golf swing. How do you hit a 250-yard drive that's super straight? Well, you swing really hard, and you make sure the club head is flat when it strikes the ball. Now that is the hard part. Fortunately, golf is harder than investing. The reason I say fortunately is because if you shank a golf ball, who really cares? If you shank your retirement, a lot of people are going to care, particularly you. That's a big thing, and it's not that hard. It's really not that hard. So take the income that you need, multiply that by 20. How do you find out what the income you need is? Well, it's really easy. Take 80% of your current income. Simple. 80% of your current income. Multiply that by 20. That's what you would need if you weren't getting Social Security or if you weren't getting a pension. Now, when you do that exercise, you're going to be shocked by how big the number is. Don't be too shocked. To start getting an estimate of what your Social Security is going to be. It's going to reduce that number by a lot. It'll reduce that number by a lot. And when you get the real number that you're going to come up with, it's still a big number. Again, back to our example. So there's a household, $70,000 income between the two. Two wage earners. Maybe they have a child or two, and one of them has to stay home during the day. So they work part-time. So their household income is still $70,000. 80% of $70,000 is $56,000. Somebody making $70,000 a year today who's below the age of 40, probably getting at least $2,000 a month current dollar benefits and Social Security. So that's $24,000. So 80% of $70,000 is $56,000 minus the $24,000, $32,000. $32,000 times 20 is $740,000. That's the goal. That's the goal. That's to be able to keep their lifestyle pretty much the same. So what if they said, well, what if we don't need that much? Well, you can make those adjustments. But for right now, that is the number. I know a lot of people who can get by on a lot less than 80% of what they make. I know people who get by on 25 to 30% of what they make. And it's not because they're rich. It's because they save a lot of money. I hear the music. That means I got to take a real quick commercial break. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned. I'll be right back.
I am sure all of heaven's heard me cry as I tell.
And we are back. You're listening to Bill Bullington here every Saturday morning from 11 to noon on 1420 The Answer. This show is also available as a podcast on 955thefish.com. and on my website or Apple iTunes under the Bullington Capital Report. And with that plug, I'm going to go right to Gerry. Gerry, I got a question for me?
Yes, sir. Good morning, Bill.
How are you?
This is more of a generic one. Is there any survey or statistics as far as how much percent of short sales are profitable?
No, not that I know of. And I wouldn't trust it anyway, just because by the time you were able to collect that data, it will all have changed.
Of course. I just was curious from a generic standpoint, because I would have to assume that most short sales are probably losers rather than winners, but I just was wondering if there's anything to validate it.
It would be really interesting to be able to see the data. What you'd really want to see are the trends. And right. I can tell you, when the market's going up, the percentage of short sales that are profitable are going way down. Of course. And then when the market crashes, the percentage of short sales profitable is probably closer to 80 and 90%.
Okay, but on a short sale, you have to sell on an uptick. You can't sell on a downtick. Is that correct?
Well, that's what they say. I don't know if you've ever watched executions on trades before with all these computerized programs.
Okay.
That's supposed to be a rule. I'm going to tell you right now, there is no way to enforce that.
Okay.
Yeah, and the SEC get really mad at me for spilling the beans on that, by the way. But so I'm taking a little risk there. But
okay.
Yeah.
One other question I wanted to put to you: how about profitable trades? Say puts and calls. Are they,
that's
calls, or is that again something that really is not documented?
It's documented somewhere. Again, you've got so many different exchanges now, electronic exchanges. The data's out there, but most of the exchanges don't want to publish that information because the number is abnormally large as to what percentage of losers, particularly by public, people that aren't institutional investors.
Right.
It's above 90%.
Wow.
Yeah, unless you're doing covered calls, and that's a different animal altogether.
I would assume that you're probably going to be able to make more money on sell side rather than the buy side.
I would think so too. I would think so. Now, the real money is made by the market makers, and they've got sophisticated algorithms, and they can kind of tell the ebb and flow on various options contracts, which is a big part of that. And that's something that you and I are never going to have access to. So they do have a built-in edge. There is a guy, though, teaches classes and actually does a really good job. What used to be the on the floor of the Chicago Options Exchange, and you can go look him up on online on meetup.com. It's the Hudson Trading is the name of his company. Pardon me?
You said Hudson Trading?
Yeah, hang on one second.
Sure.
Yeah. I'm actually bunch of dead air. His name is Joe, and I have to apologize because I've talked to this guy a gazillion times, and my concussions are kicking in right now.
It could be a senior moment too, William. You're getting up.
Well, yeah, I got that going for me too.
All right, take care.
All right, have a good one. Thanks.
Bye-bye.
Yeah, I hate when that happens. This happens a lot. In fact, I had this intimate dinner with like 10 of my clients, 10 of my closest clients, and I could not remember one of his names. He's been with me for 25 years. I talk to him all the time, and I just blanked out. I don't know. Let's see. Hang on a second. Joe Waterman. There you go. I knew that would come back to me. That is so embarrassing to have that happen. Especially on the radio. when there's probably more than 3 people listening. But anyway, if you call in, want to call in, 216-901-0945, 216-901-0945. And there's a guy, he teaches a lot of really sophisticated strategies, you can do very well if you've got that knowledge. And I think you're probably going to have to get I don't think I know. You're going to have to get a very sophisticated platform if you want to trade options. And that's why I want to get Joe on the show, and we'll promote his thing. If you go to meetup.com, just Hudson, I think it's Hudson Trading Group. Hang on a second. I can actually, I'm looking this up on the internet while we're doing the show, which I probably shouldn't be doing, but I'll do it anyway. And making it very difficult to type the way my hands are. Meetup Hudson Trading. There we go. There we go. Here, it's bringing it up. Yep. Yeah, just type in Hudson Trading Meetup. Hudson Trading Meetup. It'll bring you right to his thing there. Super nice guy. Joe's a great guy. He's been to several seminars. He just moved back to this area. Was actually from Cincinnati. Moved to Chicago. Lived there for a long time. His wife lives here. I'm telling his whole life story. It's like when he retired at a really young age. So he's really good at what he does, and has come into this area and has got bored teaching these programs. And actually, you got to question. He's the man. And I'll get him on a radio program at some point in time. Because this is it's pretty fascinating. What really fascinates me is they don't really teach the guys much about fundamental analysis on stocks or trying to determine whether there should be a movement in a particular direction. They don't really care about that. Yeah, and I just find that completely fascinating that they don't really care that much about the direction. And I know why, and they're right. For their time periods, you shouldn't really pay that close attention to it. It's good to have a little bit of an idea. It can help you, but it's not going to help you that much. Anyway, that stuff is super sophisticated, and if you don't want to spend a lot of time learning a lot of language, or if you want to speed up that process, I'd hit up Joe. Hudson Trading Company, meetup.com. So now that I plug that, anybody else has a business they want to plug, feel free to call in. Just kidding. If you have any questions regarding any of this, the retirement planning things, it's kind of a, like I said, I'm a little upset that they make it so complicated. It's not that complicated. The two biggest worries that most people have in retirement is running out of money. Obviously, it takes a lot of money. It takes a lot of money to be able to walk away from your job. And you have to invest decently. You don't have to set the world on fire. Now, some people do. If you come in and you've got $200,000 saved and you're used to spending $100,000 a year, that's really a tough spot. That's an incredibly tough spot. To be able to make that kind of money, probably not going to happen. At least not on purpose. Might happen on accident. If you win the lottery or something, that'd be great. But and if essentially that's what you're going to have to do. But for the average person, you need to start thinking about this in your 30s, probably your late 20s. The longer period you have, the better you have to do it. It really takes a lot of heat off of you. You don't have to make an enormous amount of money on your investments. You need to earn a return. You need to earn a decent return, and you need to put a decent size, a decent percentage of your salaries away. And we can do the analysis for you really quickly. In fact, I was thinking about this at the next seminar. I did this a long time ago. I printed out these sheets. So if let's say you're going to average a 6% return or 1% return over the next 40 years, I have a spreadsheet. I'm just going to hand them out as work at the next workshop. Take the income that you want today, take the inflation rate that you think you're going to have, and go down so let's say it's $50,000, and 20 years from now you think inflation is going to be 2 or 3%. You can go on this handout and see what it's going to take to have that much money in the future. So that's how you establish your goal. It's basically what I did when I was in my late 20s, early 30s. When I first started studying this, it was a long time after I've been working for a long time. It just wasn't really talked about. Nobody really talked a whole lot about this. And it's unfortunate because it's really needed, and we've undersaved. We've undersaved and we've underinvested. But now, with all the resources I see that are kind of similar to what I'm talking about, this knowledge is actually becoming much more prevalent, and people are, they've got a chance, but you still got to get it out there. It's still in its infancy. People aren't talking about it as much as they really need to be, and they really need to talk to 12-year-olds about it. By the time you're 12 years old today, those kids are smart. A 12-year-old kid's really smart, probably as smart as a 35-year-old was 40 years ago. Yeah, actually probably smarter because they didn't know how to use a smartphone. Some of them still don't. And these kids, they can do all this stuff, and this math is just not that hard. Oh, man, I can't believe it. The show's over. Hey, you've been listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Feel free to give us a call or stop by my website, bullingtoncapital.com. Thanks for listening, everybody. Have a good week and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.